problem 1 from chapter 8, this is exercise 8.3 in your textbook, is a little different kind of problem. It's a different kind of business entity, but a very common one, and one that some of you are bound to end up be working with and managing in the future. This is a partnership. 2 or more people getting involved for any legal profit-making endeavor. The business acquired $44,000 cash from Busby and $66,000 from Beatty. So that determines their percentage of ownership. One owns a little more than the other because he or she put a little more in. The partnership earned $42,000 in revenues, paid $18,000 for cash expenses. Busby took $2,000 and Beatty took $2,500. The net income was allocated. Now here you got to learn accounting terms. Not tough, you just have to learn them. Was allocated to the partners in proportion to their ownership. So we need to prepare an income statement, a capital statement, a statement of changes in equity, balance sheet, statement of cash flows. We've done all those for corporations. The only thing new is that this is now a partnership. So instead of having lots of shareholders, we have 2 partners. These 2 ladies, Busby and Beatty, started this partnership. So let's take a look at the cash contributions first so we get an idea of the percentage. So Busby put in $44,000. Beatty put in $66,000. That's a total of $110,000. So 44 over 110, that's 40%. Don't believe me. Do the math. Poke it out on your calculator. So Busby, her portion is 40%, and Beatty's portion is 60%. And that's the way they're going to split everything. Income comes in, it's 40% Busby, 60% Beatty. Expenses, 40% Busby, 60% Beatty. So they then tell us that this company had $18,400 in expenses and $42,000 in revenues. So that's no figure in there, it's just a matter of writing it down. We'll do it over here so we have some space. $42,000 in revenue, $18,400 in expenses. Busby withdrew $2,000 and Beatty withdrew $2,500. Okay? So, that's the information we need. We'll refer back to that often as we go through the financial statements. Here comes the income statement. This is going to look really familiar to you. Income statement, just like we've done from day 1. Revenue, $42,000. Expenses, $18,400. Net income, $23,600. Now, when we were doing corporations, we had a thing called retained earnings and equity. Remember that? Well, this is a partnership. So instead of equity, they have a capital balance. Means the same thing. We just use a different word. Okay? So the beginning capital balance was 0. We just started. The two partners combined to contribute $110,000. The net income, just like it was in corporations, goes to retained earnings. We don't have retained earnings. We have capital balance. So we add the net income, $23,600. Just exactly the same as we did with a corporation, minus the withdrawals by owners, which prior to this, when we were talking about corporations, we talked about dividends. They mean and they act the same way. They reduce the capital balance. Remember, between them they took $4,500. Busby took $2,000 and Beatty took $2,500. So what we started with plus what we earned minus what our partners took, our ending balance $129,100. If this were a partnership, if this were a corporation, that would be the ending shareholder equity. This is a partnership. So it's not shareholder equity, it's partner capital balance. Okay? Now, if you wanted to, and they don't necessarily ask you to, but I want to show you this just so it helps bring home what's going on here. Let's take a look at their accounts. Now remember, in corporations, you only have one account called retained earnings. Here we have two accounts, one named Busby, one named Beatty. At the beginning of the year, neither Busby nor Beatty owned anything in the company. They hadn't started it yet. Busby put in $44,000. Beatty put in $66,000. For a total of $110,000. These are the same numbers we've done, just laying them out a little different so you can see how we ended up with those ending capital balances if we do it this way. You'll see the numbers are exactly the same. The net income was $23,600. That hasn't changed. It's exactly what we did before. Now, 40% of that belongs to Busby. So 40% of $23,600 belongs to Busby. That's $9,440. So that's 40% of $23,600. 60% of that $23,600 belongs to Beatty. That's $14,160. Busby took $2,000 out for her personal use. Beatty took $2,500 out for her personal use. The total the partners combined took out was $4,500. Now add up their capital balances. Busby $44,000, what she put in, minus the nut plus $94,400, minus $2,000. $51,440. Do the same thing for Beatty. She started with $66,000. She earned $14,160. She withdrew $2,500. $77,660. If you add down, you'll come up to that number. You add across, you're going to come to $129,100, no matter which way you do it, which is exactly what we did when we worked out the capital balance for the entire partnership. So you can do it either way. I like this way, it's a little more straightforward. But in either case, we're allocating that net income and we're changing the capital balances. Okay, now remember, the original document is the document that controls the entire transaction. So the next thing it wants us to do is a balance sheet as of the end of the year. And we only have one asset. They didn't tell us anything else except they had $129,100. That's a total of the cash that was invested and the cash that was owned. So that was $129,100. So the total assets, $129,100. There were no liabilities. This should look very familiar to you. Instead of having retained earnings for all the shareholders, we have capital accounts for the individual partners. So for Busby, we have the $51,440. That was the number we worked out just a minute ago. And for Beatty, we have $76,660. 77760. And just like in a corporation, total liabilities and total equities equal the total assets. So it's really no different than what we've been doing, except this is now a partnership owned by two people as opposed to a corporation that could be owned by thousands or perhaps even millions. The next thing it wants us to do is a statement of cash flows for the partners. And I know every time I say statement of cash flows, half of you go, oh, it's not that bad. Honest, it ain't. I promise. So, let's take a look at the cash flows. First, we have the cash flows from operating activities. This is the cash that we earned doing what we do. And that's from the very first set of information that they earned $42,000 in cash and paid $18,400 in cash. So cash in, $42,000. Cash paid for expenses, $18,400. Net cash from operating activities, $23,600. That number should look really familiar to you. Remember, investing activities, property, plant, equipment, buildings, they didn't buy any of those. How do we know they didn't buy any? They didn't tell us. So we'll leave that blank. Now, this is the only thing that's different is the financing activities, because instead of common stock, capital stock, preferred stock, investment, all of that stuff, you have two folks putting in money. So the proceeds from the partners, that's a financing activity, $110,000. The partners took $4,500, that's a financing activity. That's $4,500 out. So the net cash from financing activities, $105,500. 4,500 subtracted from the 110. The net change in cash is the 129.10. That's what we had at the end of the year. 129,100. I said 110. If you add this up, it's 129. If you look at the beginning cash balance, 0. Look at the ending cash balance, 129, 100. So it's really exactly the same. It's just a couple of different terms. And partnerships are very common in the hospitality industry. Some really big companies are partnerships. And this is the way their financial statements are done. Because a partnership can be between two people, or it can be between two corporations. So this could be between Smith Co. and Jones Co. So instead of proceeds from Bob and Sally, it'd be proceeds from Smith Corporation, proceeds from Jones Corporation.